everyone. This week we'll start chapter 7. This should be another relatively short one here. So this chapter is about why do financial institutions exist. So they start by showing this graph here. So it may be surprising to some because the stock market is talked about all the time. It gets a lot of news coverage, obviously, but actually the portion of loans that are stocks, obviously that's how a firm finances investment and things like that. A very small percentage of that is actually stock. And they go through 8 facts about the financial structure, which are in the slides, so I don't think I need to repeat them for you all. So let's move on to transaction costs. So they talk about, as an individual investor, how certain asset prices may prevent you from buying stocks or bonds that you want. So for example, I looked today and Amazon stock is right around $3,200 a share. So as a college student like me, I'm guessing that you don't have the money to buy maybe even 1 share, let alone if you want 10 shares. So, of course, that prevents you from investing in certain companies. So, how do financial intermediaries reduce transaction costs? And they talk about economies of scale. So, actually, even if you only have, $50, $100, you can invest that and actually buy partial Amazon stock. And this is through something called a mutual fund. So essentially, there are institutional owners that will buy in bulk, essentially, of all of the firms on the S&P 500. And they will package them together in what is called a mutual fund, so individuals can buy shares of the fund. So obviously contained within that is very small portions of all of these different stocks. So again, even if you only have $100, you may own, 0.01% of an Amazon stock, for example. So this allows you to diversify even with very small portfolios. Of course, if you had to do this all with individual stocks to diversify, you would not only have to buy Amazon, you'd have to buy, 10 other stocks. So this is a solution to the transaction cost. Next, they talk about asymmetric information, and that is essentially, in some capacity, what the rest of the chapter is about. So asymmetric information it occurs when 2 sides of a transaction don't have the full information about the underlying asset. So essentially it's when insiders know more than the investors. So of course this kind of makes sense if, even if you're not the CEO, you just work for a company, say you work for Procter & Gamble, you may know more about the future of that company than an investor. So this would be especially true if you were the CEO, of course. So this can lead to something called adverse selection. So this occurs before a transaction, and it occurs when asymmetric information is exploited. And then they define the moral hazard part as after that transaction occurred. But it's all due to this asymmetric information. These are just adverse selection, and moral hazard is the idea that the insider is exploiting the fact that there is information asymmetry. So think about insider trading. So obviously when this happens, think of a circumstance where a CEO knows maybe that their firm is facing a lawsuit in the future, and it hasn't been made public yet. So he or she may decide to sell a huge portion of their stock to investors who don't know that's going to happen. So, of course, the price doesn't reflect that information yet, as we talked about in the last chapter. But, of course, once the lawsuit is made public or the information is known, then, of course, the stock price would drop. So, essentially, the CEO is profiting from that at the cost of whatever investors bought that stock. So this whole dynamic of asymmetric information and the possible effects, the field that studies that is called agency theory. And also, if you all have ever taken an economics course, you may have heard of this already, but this leads to something called the Lemons problem. So a quick example, if you think about the used car market. So consider you need to buy a used car. And you know that some used cars are good and some are not good, or what they call the lemon. And in the book, they also call the good car the peach. But to you, they appear the same. You don't know which one is the lemon, you don't know which one is the peach. So you would be, in this case, like the investor or the outsider. But the car salesman or the insider does know. So because of that, the buyer, which is you know, you can't tell the difference. So you're just going to assume the average price between the two. So consider the peach is worth $10,000. The lemon is actually worth $2,000. So this information is known to the insider or the car salesman, but not known to you. Well, I'm sorry. Yeah. So they're both would be priced $10,000. So, but you know that if there's a potential for this lemon that's worth $2,000. So essentially, you just average that together, which would be $6,000. And the problem comes when, if you think the average is $6,000, then if the insider actually decides to sell you a car, it's only going to be the lemon. He or she is not going to sell you the peach that they actually know is worth $10,000. So it results in basically always a bad deal for the buyer. So the same type of thing can happen in the stock or bond market. Essentially, it's possible that investors can't distinguish between the good and the bad quality firms, or they can't always know where the lemon is. So if recently, Tesla stock went very, very high. So Elon Musk he announced that he wanted to raise another, I can't remember what it was like $7 billion, I think, in equity. So that is a signal to savvy investors that if he's willing to do that, he must know that the current market price is overpriced. So they would then essentially they wouldn't want to buy that because it signals that may be the lemon. So some potential solutions. Number one would be the production of information. So this would be, for example, the Moody's credit rating agencies or a bond ratings agency. We talked about this a little bit a few chapters ago. However, within this is something called the free rider problem. So this is another economics term, and essentially it's the idea that the free rider problem occurs when there's a product or service that everybody wants, but nobody wants to pay for. So if you would think, if you live together with roommates or ever did, why the kitchen always is dirty, or maybe dishes pile up. Everybody wants a clean kitchen or wants the dishes washed, but nobody wants to wash everybody else's dishes. So nobody wants to pay for that, pay the price for cleaning the apartment. The next one is government regulation. So this is sort of an answer to the free rider problem because, of course, we all pay taxes, so we all have to pay for the government. So it sort of forces restricts anybody being a free rider because everybody has to pay in. So an example of this would be the Securities and Exchange Commission. And lastly would be financial intermediaries. So this is kind of the free market solution. So like auditing, consulting, or accounting firms, and you can also buy like consumer reports. I think like Nielsen, if you're familiar, they do that type of thing. So again, this kind of ameliorates the free rider problem too, because you have to pay to, essentially, the investors would have to pay to try to eliminate the asymmetric information. And this can lead to the pecking order theory of capital structure. So this is actually a huge area of research within finance that's been talked about for decades. So this comes about because of asymmetric information, and it is the theory that there's an order in which firms raise money. So if you think about the weighted average cost of capital, I'm assuming everybody's heard of that already. So of course, firms are trying to minimize that. So the idea is that equity costs more than debt, which costs more than retained earnings for the firm. So the opposite of that would be true of what they want to do. So if they want to invest in a project, the first thing they're going to do is spend their retained earnings, because that is costless. Then they're going to issue debt, and then at the very end, if they absolutely have to, they'll issue equity. So the idea is that equity is more sensitive to the belief about cash flows. So if you think about the lemon problem, again, the example I went through with Elon Musk, if you're the buyer of the car and if you know about the lemon problem, essentially, if a CEO or a firm is willing to issue more equity, that must be a signal that that the CEO must believe that equity is worth less than what he or she is trying to sell it for, which would be the current market price. And just to finish up quick, this asymmetric information is worse for firms with less transparency, of course. So there can obviously be differing amounts of asymmetric information. And just a couple of them here. This is not all an exhaustive list, but a couple are like small firms. Obviously, there's going to be less news coverage and things surrounding that. And same thing with the young firms. It's the same intuition there. So firms that have been around a while, of course, are probably studied more. Their products and services are more well known. Like again, think about like Procter & Gamble versus like a new startup tech company. And those with less analyst coverage, of course, again, that's just more eyeballs on the company, looking in their financials and things like that, knowing exactly what they do, and less institutional ownership as well. So the idea is if big institutional owners, if they own, billions of dollars of a firm's stock or bonds, obviously they have an incentive to investigate them and know what they're doing, essentially, and try to predict their cash flows. And lastly, firms without a credit rating. So that one's also pretty obvious. So again, that was pretty quick. There's really no practice problems to go over. So please look at the slides. And quiz 2 will be over chapters 5 through 7, which I will post tomorrow. And I might give you past Sunday, maybe until Monday or Tuesday to finish that. Again, if anybody has questions, please email me, and have a good weekend.